Hello, my name is Mike Creasy, an M&A Director specialising in separations and integrations. Markets have always found acquisitions easier to understand. They are seen as positive and exciting, whereas divestments, on the other hand, have been seen as a retrograde step. But times are changing. Since 2008, companies have been forced to sell off assets in order to raise capital, reduce debt levels, and for regulatory reasons. However, there are now indications that this is changing. Companies are looking to restructure their businesses in order to focus on their core markets. As a consequence, companies are now looking to divest of their non-core business divisions. With that in mind, Deloitte has undertaken a survey of companies that have made recent divestments. In particular, the report focuses on the key factors that drive value. This survey will be of particular interest to those companies who are considering making divestments. I'd now like to introduce Dan Beanland, partner in our separation and integration practice, to take you through the key findings of the report.
With a background of increased levels of divestment activity, combined with increased levels of complexity, what were the 6 key findings from our divestment survey? Firstly, companies are increasingly being challenged by shareholders, analysts, and their own boards to consider whether they are the best owner of a business. Despite this demand for greater transparency on how non-core activities are identified, over a third of those companies we surveyed did not undertake a regular review and only considered businesses for disposal once they were already underperforming. In our experience, by undertaking regular reviews of your business portfolio, it enables you to avoid a fire sale on disposal and so time the sale to extract maximum value. In many ways, separations are more demanding than integrations, but 40% of divestments were completed by teams who are managing the disposal alongside their multiple BAU responsibilities. By investing to provide clarity on the business being sold and staying one step ahead of the buyer's requirements, you increase the chance of having a quicker and higher value sale. We all know that in order to maximise sales value, you need to retain competitive tension. But our survey showed that a number of corporate sellers often ignored important buyer pools such as private equity. Structuring a disposal to show what the business could look like on a standalone basis enables bidders who do not have existing in-country infrastructure to participate. We often hear the phrase, the business is largely standalone. However, when you look under the surface, we see shared IT, processes, people, and real estate. Underestimating the challenges of unpicking these connections is the main reason why over half of the divestments took longer than expected. By focusing on the key separation challenges up front, you can structure a sales process that won't frustrate potential buyers. Most of our respondents were looking for a clean break from their divestments, but few achieved it. Transitional services agreements can be an important tool in bridging the gap between taking ownership of a business and it being totally independent of the seller. In our view, providing TSAs can be a necessary evil in getting a deal done, but for both buyers and sellers, it's important to get a good view on costs as well as the TSA exit route. Our last finding relates to the core business left after these divestments, in particular IT, support functions and real estate costs that are no longer appropriate for the new, smaller group. These stranded costs can amount to 7% of the revenues of the business being sold and are often identified late or even post-deal. Having a clear strategy on how to eradicate stranded costs is key to maximising value and ensuring that breaking up isn't hard to do.